Suppose I mentioned to you about a month or two ago that we would somehow manage to have a G7 meeting where we annoyed all of our allies, didn't sign the communique, and threatened a trade war. And how would you expect the market to react? I got to admit, I would not have expected the market to be as calm and cool and collected as we've seen it. Basically, the events of the prior weekend, where I can't recall an international meeting amongst allies ending with such acrimony, and yet there was almost no effect on markets whatsoever. And I'm not even just talking about the US equity market, international equity markets, currencies, fixed income, they all just seem to take all this in stride. The thing that I keep coming back to is a mantra that I use, is markets are really good at discounting risk. They're really bad at discounting uncertainty. And I think when you get into the realm of uncertainty, that's where you're starting to talk about politics and the whole intersection of things that are really very difficult to value. And I think lately the market's point of view is, if we can't really price it, we're just going to ignore it and move on. Remember, specifically with the equity market, you do have a very strong economic background right now. You've got relatively contained inflation. Yes, the Fed is on a rate-raising path, and that's got other stuff that will work itself through the system in a longer-term basis. But on the short-term basis, the power of the buyback and the power of solid revenue growth is enough for the stock market to keep shrugging this stuff off. The question is, how is the bond market and the currency market shrugging it off? Do they just view this trade war talk as rhetoric, and that these countries are too close to ever really engage in the sort of detrimental conduct that we're looking toward? Or is it one of these things that will react when we see it, when we know what the tariffs will be, when we know what the trade war looks like? Then we'll start to worry about it, because there have been a couple of false moves as the rhetoric has been heating up. In the meantime, though, you can see stock markets continuing to chug ahead toward their highs. You could see the VIX basically remaining in the low teens or even below the teens, and 12 handle, 11 handle even, and that reflects investor confidence. We can see if that becomes complacency. It's confidence when it's moving your way. It's complacency in hindsight when you've proven that you've been wrong. And as of now, that hasn't been the case. In February, that was the case, where the markets got overly complacent. Again, I warn people who might be looking at these low levels of the VIX to re-enter short volatility trades. Think very carefully about what your upside is and what your downside is. Using VIX as a proxy for all the other instruments like VXX or whatever you might be using, if you've got a VIX that's trading at roughly 12, where is it going to go? 10? 9? That's about it. They're not going to just outlaw volatility altogether. So you're hoping to make maybe 3 VIX points on this. If you're wrong, you can go from 12 to 18 or 20 in about a day. So the risk reward does not shape up to be in your favor. So didn't mean to throw this big cautionary note in an otherwise sanguine backdrop, but that's the sort of stuff that we need to actually worry about. When things seem too easy, when things seem too good, you don't want to be entering into trades that actually eliminate your risk or reduce your mental calculus for risk. But right now, the markets just seem to be chugging along, listening to their own music right now, and we'll see if any of the events on the horizon shake that up.